We've seen this morning that a lot of foreign capital has come in, both from European institutional investors and also more recently US private equity money as well. But we've seen it's fair to say, quite strong performance from residential across Europe as an asset class compared to other asset classes. That's been extremely powerful in the UK. Over the 12 years that we've been measuring, you've got more than 10% on average total return a year. It's important to qualify that our UK sample is quite heavily focused on central London, so it's therefore important to remove that and see how the numbers look without central London included, because that's very prime stock with values of over £1 million per unit. But if you take the central London stock out, you're still getting a total return of 9.1% per year in the UK over a 12-year period, which compares very well to the rest of Europe. It's one of the highest up there, pretty even balance between capital performance and income return. And interestingly, if you look across different countries, it tends to be the countries where there's currently a much lower representation of the private rented sector where performance has been stronger. If you look at the markets where they've got a very well-developed institutional investor market, like Germany, Switzerland, the Netherlands, the total returns typically over the long term, you're looking at about sort of 5 to 6%, with most of that coming from the income return, fairly stable, if not flat, capital performance of around about 1% a year in the long run. Whereas markets like the UK, where there's a much higher proportion of owner-occupier demand, are posting the returns of more like 8, 9, 10%. The income returns are still around the 4% level, but they've enjoyed that capital appreciation as well, with strong rental growth in those markets, keeping rents somewhere close to check with the capital growth so that the yields haven't been compressed too far. But that's not the case for central London. We've experienced enormous price growth and extreme yield compression in central London to the point where you're probably only going to get a net income return of about 1.5% or something on assets there.